Welcome to Civil Analytics. I normally do analytics videos for basketball, but going forward, I'm also going to be doing videos that talk about things that are happening to the economy. It will include topics about the real estate market, money and banking, the labor market, and other things that may impact the U.S. economy. And so these videos will review the facts, and then it'll be followed by some analysis. And hopefully, the analysis will help shed some light on how these topics impact our lives. I will also share some. Um, I will also share how these issues shape my personal behavior and decision as a consumer, and also as an investor. One thing I do need to make clear that these videos and these contents and today's video is strictly for educational purposes and entertainment purposes. I'm not here to give you investment advice. And so, with that said, let's get into the hot topic of 2022, which is about inflation and the Fed's ability to fight off inflation. We know the world has been suffering from inflation as the economy reopened after being shut down by the pandemic. Now, here in the US, the Federal Reserve's mandate is to maintain price stability and maximum employment. And so this year, their focus has been solely on reducing inflation. Their goal is to reduce the long run inflation to 2%. We need to keep in mind that for August 2022, inflation was around 8.2%. And like I just said, the Fed wants to get this down to about 2%. Jerome Powell just last week announced that the Feds were going to raise the Fed funds rate by about 75 basis points. And so now that brings the federal funds rate to about 3 and 3.25%. That's where it's sitting at the moment. Now the question is, how much pain would the economy feel before the Federal Reserve achieves their price stability, right? How far would unemployment have to rise for us to reach this 2% target inflation rate? So the OECD estimates an economy is at full employment when unemployment rate is between 4 and 6.4%. The unemployment rate currently is sitting at 3.7%. So we should assume the Feds will force unemployment to rise above 4% while they monitor these prices. Their hope, they're hoping their actions, right? Um, they're hoping their actions slow down spending just enough to get inflation under control without causing a deep recession. Still yet to be seen if that's going to happen, if they're going to be successful. But it seems like from everything they've said, it seems like that is um, what they're trying to do. That is their goal. So, what does it mean for everyone in the U.S. economy, and what are some of the negative effects rising rates will have on our economy? And so, one thing I automatically think about is home buying, right? So, if you're looking to buy a home, higher rates will make it more expensive to buy a home. The higher the interest rate is, the more your monthly mortgage cost is going to be. The same thing applies if you're a real estate investor. We can assume that rising rates will cause a slowdown in the real estate market. Consumer spending makes up about 70% of GDP, and homes are the largest ticket items that people purchase in the U.S. Now, if people stop purchasing homes, builders won't be able to build as many homes. We can assume the builders would employ less workers, and so this first domino falling will leave a trail of demand destruction. There'll be a trail of demand destruction that's gonna uh, will leave a trail of demand destruction throughout the whole economy. It also makes it harder for businesses to borrow money for expansion or even to fund current operations. The mere act of raising rates will force businesses to lower their revenue guidance, and they will also be less likely to hire as a result. All these dominoes falling will lead to higher unemployment. And so, thinking about going back to home, purchasing a home, and what this Fed policy is doing to your ability to purchase a home, it kind of makes me think about what I'm going through right now. So right now I'm in the process of purchasing a home for my growing family, and these higher rates definitely makes the decision process a lot more difficult. It doesn't make it any easier. Um, Although rates are much higher, though, I am starting to see prices cool just a little bit. We're starting to see prices cool just a little bit. And so I want to look at some charts that look at basically home values over time. And so the first one I want to look at here is the home value. So this chart tracks home value over time. It begins from the year 2000 to 2022. As you see here, values go rise from the year 2000 all the way up until around 2007, and the values then began to decline from 2007 until around 2012, and then it begins to recover again. And as you guys notice, in 2020, which is the beginning of the pandemic, if you notice there's a dramatic rise in the value in home values around between March and June 2020. And from there going forward, it basically rolls up until this year. And it's hard to tell from this chart, but it kind of looks like the price does cool off a little bit, but it is hard to tell from looking at this chart. What we can do is we can look at, we have another chart that looks at the growth rate of the home values, right? And so that's the second chart that we have here. And so we're going to pull this chart up. And so this here tracks home value, the growth of home values from year 2000 to 2022 as well. And as you guys see, there's a dramatic fall towards the end of 2021 into 2022. We start to see a collapse, a fall in the growth rate of these home prices. And so it feels like kind of coincides with the Federal Reserve policy of quantitative tightening and higher interest rates. Uh, and so what I want to do is look at the third chart. Now, this third chart tracks the Federal Reserve, the size of the Federal Reserve balance sheet. This is the balance sheet trends for the Federal Reserve. And so it tracks the size of the balance sheet over time, and it's starting from 2008 all the way to 2022. And as you guys see here, this is basically early in 2022. That's when they began the quantitative tightening here, and they began to reduce the balance sheet. And like I said, it seemed to coincide with this sharp drop off here in the growth rate of home prices. And so just to kind of try to further prove this point, I have this fourth chart over here. The fourth chart that I have here, it's looking at, in blue we have the median Federal Reserve balance, the median balance for the Federal Reserve balance sheet, and then in the orange we have home prices, and these are over time. These are trends going over time. And as you can see, the home prices moves in lockstep with the Federal Reserve balance sheet, the size of the Federal Reserve balance sheet. And so it's just to kind of further prove the point that the policy of quantitative tightening does have an impact on home prices. And so that's pretty much all we want to show. That's pretty much what we want to show there. So it kind of gives us an idea of what's happening. So as the Federal Reserve, as they continue to raise interest rates, and also as they continue with the quantitative tightening, we can continue to expect to see we should continue to expect to see home prices cool down and fall. How much more, we don't know. Right now, all we're doing right now is just speculating. However, we can assume that it's, the prices will continue to fall if they keep raising rates, and also if they continue with the quantitative tightening. Now, home buyers and real estate investors are not the only people that are going to be feeling the pain. Uh, Equity market investors are also feeling some pain right now, and they will continue to feel some pain. So because the inflation and the Fed's attempt to fight inflation is causing volatility and declines in the equity markets. That is definitely happening. And I feel part of the reason why that is because the value of publicly traded companies, um, the value of publicly traded companies are determined by one of the things they're determined by are the interest rates. And one of the other things that is they're determined by is the how much money these companies are going to make in the future. So those are some of the two major factors that determine the value of the company. And so as we see higher rates, as interest rates go higher, the lower a company is valued, right? And so as a result, we can definitely assume that investors are going to continue feeling some pain, uh, as inflation continues to be an issue, and also as the Federal Reserve continue to work to fight inflation by raising its rates and also by reducing the balance sheet. And so moving back to more on the personal side, um, our family also noticed in terms of inflation's impact on our personal behavior and our personal finances, we definitely noticed that the inflation uh, did begin to have an impact on our savings. Right before, we used to order groceries uh, through Amazon without even really thinking much about it. But now, a couple of months ago, we actually had to create a food budget. And so we actually strictly follow our food budget every week as a result of that because these higher prices we're really starting to see the impact. And so we actually had to make adjustments and actually create a budget and begin to follow the budget just to make sure um, we're basically able to do what we need to take care of our finances and also to be able to save in the process. I definitely would love to hear how inflation and how these higher rates are beginning to impact or how it impacts your personal behavior and how it impacts your finances. So I would love for you guys to please comment below and feel free to share how the higher rates and also how high inflation is impacting your personal finances, or even what you think it might, how it's going to impact our community at large, or even the U.S. economy. Whatever you have to say, I'll be more than happy to respond to your comments. Um, Also, the other thing I want to say is that this video, as it fades, please remember to like the video, subscribe to the channel, and I'll catch you guys on the next video. Thank you so much and have a good day.